So most people have to file for federal income tax, but if your income is low, you don't have to do that. Again, the primary reason behind that is that if you would not even start paying taxes unless you earn a certain income, I forget what that amount might be, maybe $15,000, something along those lines. So at any rate, the people that have to file the different categories would be single or divorced or legally separated, married, filing jointly. It could be married filing separately as well. Could be head of household. So if you're a single parent, for example, or you're a single person who's adopted children, etc. Um, that would categorize you as the head of household. Unmarried individuals who has, again, for example, a child or a dependent relative, somebody perhaps on disability, qualifying widow or widower. That's for a 2-year stint that you'll be filing under that category. So selecting the proper tax forms is basically there were three forms. The 1040 Easy and the 1040A. Now there's only the 1040, which is again as a result of the Tax Cuts and Job Act. So when you're filling out your tax form, your 1040, you'd have to put in, of course, your filing status and any exemptions that would be associated with it, the income, adjustments to that income, and then the computed tax, other taxes such as self-employment taxes, any kind of tax credits, payments, withholding taxes, how much you've already set aside, you've already paid in, if you will, and then from that you end up with your refund or the amount that you owe, signing your form, of course. And this you can pretty much do this electronically now, but you can still use a paper form if you choose. So if you have to correct your federal form, you've got to file what's called a 1040X, and it does happen. I've only done it one time myself where it made a mistake and I had to refile. And it was something that I had done where it was to my benefit. So I ended up getting paid more because I should have said a return. My refund was higher than it was prior to that, so they sent that money along. That's called a 1040X. So state taxes, you have to file for that as well. Like for example, in Michigan, I think it's about a 4% rate on your income, and then there's a certain amount again. There's an excluded portion, or there's a standard deduction that would be associated with that as well. Typically due on the April 15th, the same as the federal, but I'm not sure if, like for example, Michigan might be the end of the month, like April 30th, or it has been in the past at some point in time. So different strategies so far as like filling out your forms. You could do it yourself, of course, and going through it. You could also go through Tax Preparer, or you can use software such as like a TurboTax or Tax Cut, all kinds of stuff out there. But the point again is that whoever does your taxes, whether it's you filling it out on paper or doing it electronically through one of these tax applications like TurboTax, Tax Cut, there are a variety of them that are out there. You're the one that's responsible for for the information that goes in, and you may end up having to have an audit, which is unusual. However, when I say unusual, I've only never been through an audit myself. For myself, I've been actually accompanied a sibling who was going through an audit, and it was not as terrible as you might think. But the point again is that the audit is government stepping in and saying you made a mistake with your taxes, or there's something wrong with your taxes, and we want to clear it up. So that's what an audit really is all about. But again, to reiterate the point that you are the one that's responsible for your tax for your taxes that you submit, your the forms, paperwork that you submit, regardless of whether you do it yourself or it's through a tax preparer. If you typically with a tax preparer, that person would agree to to accompany you on that audit. But anyway, just points to mention. Again, this is just quickly so far as like filing your taxes. The way it's gone now is that pretty much you can file online. You can file for free for the most part. At the federal level, like for TurboTax, for example, you can file for free. There's no charge at the federal level, but at the state level, you are charged for filing. There's a filing fee that would be associated with it. So it's again, these are just things to kind of keep in mind as you go forward. Is that this is just a reminder that most everything is done online now, so far as like tax preparation is concerned. Something to keep in mind, again, I've mentioned this before, but you are the one that's responsible for your tax form. Whether you fill it out yourself or you hire somebody else to do that, you are the responsible party because you did sign off on it. So if there is an audit, for example, if you're in, the audits are again, they're few and far between. About 1% of all tax filers are audited. And that's typically if something pops up, something that's kind of untoward, like unusually large number of deductions or whatnot. That would kind of prompt an audit. There are different flags that are out there that the IRS, the Internal Revenue Service, kind of looks at. So anyhow, you've got rights, of course, associated with that, with the audit, and there's time for preparation, clarification, and so on and so forth. With if you are notified that you have to undergo an audit, you can actually contact them and maybe you can clear it up even before you walk through the door. Just things to kind of keep in mind. So the objective is that you want to avoid taxes whenever possible. You're not evading taxes. You don't want to pay more than your fair share of taxes. Anyways, I'm not going to get into that. I was going to say there was somebody that, a federal judge that it was great. He had a great name, and that was basically what he was saying, is that you pay your fair share of taxes and no more, no less, but no more than your fair share of taxes. So there are different paths in which you can take to kind of reduce your tax burden, if you will. Accelerating deductions if you expect to have the same or lower tax rate next year. Delay the receipt of income if you expect to have the same or lower tax rate next year. Delay deductions if you expect to have a higher tax rate next year. Accelerate the receipt of income if you expect to have a higher tax rate next year. There are different ways that you can do these things. You can kind of move the bar a little bit to help yourself along the way, and you should definitely take advantage of everything that you can along those lines. So there are different strategies that you can employ. Again, this is for itemizing, specifically. I think something on the order of 75 maybe, or maybe even 80% of people now just go with the standard deduction. But anyways, having said that, different tactics that you can employ. Again, mortgage interest and property taxes are deductible when you itemize. Consumer debt, if you buy a car, you might want to consider taking out a home equity loan in order to make that purchase. Or if you want to consolidate some of your debt, you could do something along those lines as well. Home equity loan on your home is what I'm saying, is that interest then can be deducted on your taxes. Job-related expenses, job search, etc., healthcare expenses, able to reduce your taxable burden, and especially with things like flexible spending accounts or HSAs, health savings accounts. A lot of kind of cool things. And so far as investments are concerned, if you want to focus on tax exempt investments at the federal level, you would be buying municipal bonds, et cetera, things like that. And vice versa for if you wanted to buy federal income tax, you could use, if you wanted to buy federal bonds, savings bonds, et cetera, they could be, would not be subject to tax at the state level. Things to keep in mind. Tax-deferred investments, annuities, etc. And just there are a whole slew of things that you can consider when we're talking about investment. Capital gains are profits from the sale of stocks, bonds, or real estate. Taxes paid when sold. This is different from when we talk about capital gain versus normal income, if you will. Capital gain would be taxed at a lower rate, depending upon when you realize that capital gain. Anyhow, so various tax strategies that could be employed. For example, if you have children, you could do some income shifting. Investment income of more than $2,100 is taxed at rates that are applicable to estate and trust for the child that's under the age of 18. Retirement education plans, traditional IRAs, Roth IRA, which is you're paying your taxes up front, and so any gains thereafter on that investment, including the principal, the amount they actually put in, it won't be taxed, but you pay the taxes up front. Coverdell education savings accounts, 529 Keogh plans, 401ks. These are all different types of investment savings vehicles, if you will. So, again, kind of in summary, just walk through this. So timing the receipt of your income and payment taxable expenses in relation to your current and future tax rate, taking advantage of tax credits for which you can qualify. So timing your income, if you will, is the first piece. So taking advantage, again, of those tax credits, maximize contribution to tax-deferred retirement programs, to your 401k or your IRA. Consider tax-exempt investments such as municipal bonds. Again, we're talking about federal taxes here. Defer capital gains and accelerate capital losses. Take advantage of tax benefit for owning your own business. Plan purchases, be careful about this, the tax implications that would be associated with purchasing a home or whatever, or taking, using your health insurance or buying health insurance. So you want to look at all these items that can be itemized, if you will.